Hello and welcome to my channel. Dividend stocks can be a great choice for investors looking for passive income. But, what are dividend stocks? Dividend stocks distribute a portion of the company's earnings to investors on a regular basis, normally, every 3 months. Most American dividend stocks pay investors a set amount each quarter, and the top ones increase their payouts over year, so investors can build an annuity-like cash stream. Investors can also choose to reinvest dividends if they don't need the stream of income. Companies that pay dividends tend to be well established, so dividend stocks may also add some stability to your portfolio. Investing for income? Dividend stocks versus dividend funds. There are two main ways to invest in dividend stocks: through mutual funds, such as index funds or exchange-traded funds that hold dividend stocks, or by purchasing individual dividend stocks. ETFs or index funds offer investors access to a selection of dividend stocks within a single investment. That means with just one transaction, you can own a portfolio of dividend stocks. The fund will then pay out dividends to you on a regular basis, which you can take as income or reinvest. Dividend funds offer the benefit of instant diversification. If one stock held by the fund cuts or suspends its dividend, you can still rely on income from the others. Looking for passive income? Learn what it is and how to start earning it. Whether it's through dividend stocks or dividend funds, reinvesting those dividends can greatly enhance your return on investment. Dividends typically increase the return of a stock or dividend fund by a few percentage points. For example, historically the total annual return, which includes dividends, of the S&P 500 has been, on average, about 2 percentage points higher than the index's annual change in value. And that difference can really add up. A $5,000 investment that grows at 6% annually for 20 years could grow to over $16,000. Bump that up to 8% growth to include dividends, and that $5,000 could grow to over $24,000. In general, a good rule of thumb is to invest the bulk of your portfolio in index funds, for the above reasons. But investing in individual dividend stocks directly has benefits. Although it requires more work on the part of the investor, in the form of research into each stock to ensure it fits into your overall portfolio, investors who choose individual dividend stocks are able to build a custom portfolio that may offer a higher yield than a dividend fund. Expenses can also be lower with dividend stocks, as ETFs and index funds charge an annual fee, called an expense ratio, to investors. How to invest in dividend stocks? Building a portfolio of individual dividend stocks takes time and effort, but for many investors it's worth it. Here's how to buy a dividend stock. 1. Find a dividend-paying stock. You can screen for stocks that pay dividends on many financial sites, as well as on your online broker's website. I like to use Trading 212. 2. Evaluate the stock. To look under the hood of a high dividend stock, start by comparing the dividend yields among its peers. If a company's dividend yield is much higher than that of similar companies, it could be a red flag. At the very least, it's worth additional research into the company and the safety of the dividend. Then look at the stock's payout ratio, which tells you how much of the company's income is going toward dividends. A payout ratio that is too high, generally above 80%, though it can vary by industry, means the company is putting a large percentage of its income into paying dividends. In some cases, dividend payout ratios can top 100%, meaning the company may be going into debt to pay out dividends. 3. Decide how much stock you want to buy. You need diversification if you're buying individual stocks, so you'll need to determine what percent of your portfolio goes into each stock. For example, you're buying 20 stocks, you could put 5% of your portfolio in each. However, if the stock is riskier, you might want to buy less of it and put more of your money towards safer choices. If you're going to reinvest your dividends, you'll need to recalculate your cost basis, the amount you originally paid to purchase the stock. The number one consideration in buying a dividend stock is the safety of its dividend. Dividend yields over 4% should be carefully scrutinized. Those over 10% tread firmly into risky territory. Among other things, a too high dividend yield can indicate the payout is unsustainable, or that investors are selling the stock, driving down its share price and increasing the dividend yield as a result. Another thing to keep in mind is that dividends in taxable brokerage accounts cause taxes to be realized in the year the dividends occur, unlike stocks that do not pay dividends whose taxation primarily occurs when the stock is sold. For investors with taxable accounts and in high income brackets, dividend stock might not be as tax efficient as other options. Thanks for watching this video. Stay tuned for the next one next month. To do so, click on the subscribe button and don't forget to hit the bell to receive the notification. See you soon.